There is a strange paradox at the center of Warren Buffett's life. He became one of the richest investors in history, but he spent most of his career refusing to do the things people normally associate with getting rich. He did not chase the hottest stock of the year. He did not try to predict every rise and fall in the market. He did not build his reputation by making dramatic trades every morning. He often allowed enormous amounts of cash to sit untouched, while other investors rushed toward the latest opportunity. And when someone promised quick profits, his instinct was usually not excitement. It was suspicion. Buffett once gave investors a remarkably simple rule. When promised quick profits, respond with a quick no. That sentence captures almost everything important about his philosophy, but it can sound confusing. If an investor wants to make money, why would he reject opportunities to make it quickly? Why wait years when a market can move in minutes? Why hold the same company through recessions, political crises, technological changes, and periods when everyone else seems to be earning more? The answer is that Buffett never thought of investing as a game of predicting prices. He thought of it as the careful purchase of productive assets. To him, a share of stock was not a lottery ticket with a flashing number attached to it. It was a small piece of a real business. That business had customers, employees, factories, brands, costs, competitors, and the ability, or inability, to produce cash over time. Once you see a stock that way, the entire game changes. The question is no longer, will somebody pay me more for this next week? The question becomes, what will this business produce for its owners over many years? That difference sounds small. It is the difference between speculation and investment. And Buffett learned it slowly. He bought his first stock when he was 11 years old. The company was called Cities Service. He purchased 3 preferred shares for himself and 3 for his sister at a little over $38 per share. Soon after he bought them, the price fell to around $27. Imagine being 11 years old and watching a meaningful part of your savings disappear on paper. Buffett waited nervously. When the price eventually recovered to around $40, he sold and collected a small profit. He had escaped, or so he thought. The shares later rose to more than $200. The lesson was not simply that he should have waited longer. Sometimes a stock rises after you sell for perfectly good reasons, and regret can be just as irrational as panic. The deeper lesson was that Buffett had allowed the price to control his thinking. He had not developed a clear understanding of the business and its value. He was watching the scoreboard without understanding the game. As a teenager, he remained fascinated by money. He delivered newspapers, sold chewing gum and soft drinks, placed pinball machines in barbershops, and read almost everything he could find about markets. He studied charts and tried to discover patterns in the movement of prices. This is a natural place to begin. A chart feels like evidence. It appears scientific. A line moves upward, another line crosses it, and the human brain immediately searches for a pattern. We are built to detect meaning, even when the pattern may be random. Then Buffett discovered a book by Benjamin Graham called The Intelligent Investor. He later said that the book changed his financial life. Graham offered a completely different way to think about markets. Instead of treating a stock as a symbol moving across a screen, he treated it as ownership in a business. Instead of asking what the crowd might do next, he asked what the underlying assets and earnings were worth. One of Graham's most useful ideas was the distinction between price and value. Price is visible. Value must be estimated. A price is what the market asks you to pay at a particular moment. Value is the economic benefit you expect the asset to produce over time. The two can be close, but they do not have to be. Imagine a farm that produces $100,000 of profit each year. One morning, a nervous neighbor offers to sell you the farm for $200,000. The next morning, after hearing optimistic news, he demands $2 million. The soil did not transform overnight. The crops did not suddenly become 10 times more productive. Only the neighbor's mood changed. The stock market does something similar. Every trading day, it offers prices for pieces of thousands of businesses. Those prices contain information, but they also contain fear, excitement, fashion, and impatience. Graham personified the market as an emotional business partner, often called Mr. Market. Every day, this partner appears and offers either to buy your share of the business or sell you his share. Some days he is euphoric and names an absurdly high price. Other days he is terrified and offers an absurdly low one. You are free to accept his offer. You are also free to ignore him. The market is useful because it provides opportunities. It becomes dangerous when you allow its mood to become your opinion. Buffett absorbed this idea deeply. He would later say that the market is there to serve you, not to instruct you. This is one reason he never chased quick money. Quick money thinking makes the investor dependent on the next person. You buy because you hope someone else will soon pay more. That person buys because they expect another buyer after them. The chain can continue for a while, and some participants may earn extraordinary profits. But the logic depends increasingly on crowd behavior rather than productive value. Buffett wanted a different source of return. He wanted the business itself to make him richer. If a company sold more products, raised prices responsibly, improved efficiency, strengthened its brand, and reinvested its profits intelligently, the value of his ownership could grow even if the stock market closed for several years. This idea is simple, but living by it is difficult. Human beings prefer fast feedback. If you press a button and immediately receive a reward, your brain quickly connects the action to the result. Long-term investing offers weak feedback. You can make an intelligent decision and watch the price fall for months. You can make a foolish decision and watch the price rise immediately. The market often rewards and punishes people before it reveals whether their reasoning was sound. That makes short-term success dangerous. A lucky result can teach the wrong lesson. Imagine two people crossing a busy road. One looks carefully and crosses safely. The other closes his eyes, runs through traffic, and also reaches the other side. Both received the same result, but only one used a process worth repeating. Buffett focused on building a repeatable process. When he created his investment partnerships in the 1950s, he warned his partners not to expect a smooth performance every year. He measured results over longer periods because a serious strategy could look wrong in the short term. He did not want partners who would celebrate recklessly after one strong year and panic after one weak one. That expectation was important. Money becomes impatient when it has been promised speed. If clients believe an investor should win every quarter, the investor begins making decisions to protect the next report instead of the next decade. A temporary decline becomes a career threat. Holding cash looks lazy. Avoiding a popular trend looks foolish. Buffett designed his environment to support patience. That may be one of the least appreciated parts of his success. Patience is not only a personality trait, it is also a system. If you borrow heavily, you may be forced to sell before your idea has time to work. If your investors can withdraw their money at the first sign of trouble, you may have to follow the crowd. If your lifestyle requires constant income, you may accept weak opportunities because waiting feels impossible. Buffett tried to avoid situations where time could become his enemy. He preferred strong finances, patient shareholders, and enough liquidity to survive bad periods without begging anyone for help. This leads to one of the central concepts in investing: compounding. Compounding happens when the returns produced by an asset begin producing returns of their own. Suppose you invest $10,000 and earn 10% in 1 year. You now have $11,000. If you earn another 10%, you do not gain another $1,000. You gain $1,100 because the original return has joined the original capital. After 1 year, the difference seems small. After many years, it becomes enormous. At 10% annual growth, $10,000 becomes roughly $26,000 after 10 years, about $67,000 after 20 years, and more than $170,000 after 30 years. No additional contribution is required in this simplified example. Time does more and more of the work. This is why a long horizon can be more powerful than a spectacular short-term return. A person who doubles money once has achieved something impressive. A person who earns a good return repeatedly, protects the capital, and avoids permanent loss can eventually achieve something much larger. Compounding is often illustrated as a snowball. At the top of a hill, the ball is small and each rotation adds very little snow. As it continues, its surface grows. Each rotation can collect more than the one before it, but the snowball needs a long hill. Interruptions are expensive. Taxes, fees, bad debts, panic selling, and repeated mistakes remove snow from the ball. A loss of 50% requires a gain of 100% just to return to the starting point. This is why Buffett placed so much emphasis on avoiding ruin. He did not avoid all losses. No investor can. Berkshire made serious mistakes, and Buffett discussed many of them openly. But he tried to avoid a particular kind of loss, one that permanently destroys capital or removes the ability to continue. His first famous approach was heavily influenced by Graham. Buffett looked for what he called cigar butt investments, damaged or unpopular companies selling for less than the value of their assets. The business might have only one good puff left, but if the price was low enough, that puff could still produce a profit. This method worked, especially when Buffett managed relatively small amounts of money. But it had limitations. A poor business continually creates new problems. Management consumes attention. Capital becomes trapped. The investor may buy cheaply and still spend years waiting for a disappointing company to become slightly less disappointing. One of Buffett's most educational mistakes was Berkshire Hathaway itself. Berkshire was originally a struggling textile company. Buffett began buying shares because they appeared cheap. He eventually took control after a dispute with management, but the textile economics remained terrible. The company required investment simply to remain competitive while producing inadequate returns. Buffett later described the purchase as a major mistake. The interesting part is what he did next. He did not abandon the corporate structure. He gradually transformed Berkshire into a vehicle for owning better businesses. Charlie Munger played a major role in that evolution. Munger pushed Buffett away from buying only statistically cheap companies and toward buying excellent businesses at sensible prices. That change is visible in the acquisition of See's Candies. See's was not attractive because it owned enormous factories or piles of machinery. Its strength was mostly invisible. Customers trusted the brand. The candy was connected to holidays, gifts, family traditions, and a reputation for quality. People were willing to pay slightly more for it, and the company did not require enormous amounts of additional capital to grow. This is called an economic moat. A moat is a durable advantage that protects a business from competitors, just as water once protected a castle. A moat can come from a powerful brand, low costs, network effects, patents, regulation, switching costs, or a trusted relationship with customers. The important word is durable. A temporary advantage attracts competitors. A true moat makes it difficult for them to take the castle. When a wonderful business can reinvest profits at attractive rates, time becomes its ally. The investor does not need a quick exit. The business keeps creating value. This was a profound change in Buffett's thinking. Instead of waiting for a cheap, weak company to be sold at a slightly higher price, he could own a strong company that became more valuable year after year. That is why the best Buffett investments often look boring when described as trades. He bought. Then he waited. Berkshire began purchasing Coca-Cola shares in the late 1980s. The attraction was not a prediction that the stock price would jump the following month. Coca-Cola had a globally recognized brand, a product purchased repeatedly, a vast distribution system, and the possibility of selling more drinks to more people across the world. Once Berkshire had accumulated its position, it did not need to generate activity to create the appearance of intelligence. Coca-Cola continued operating. It sold products, earned money, paid dividends, bought back shares at various times, and expanded its business. Berkshire's ownership participated in those economics. The same pattern appeared with American Express. Berkshire held through long periods rather than treating the stock as merchandise to be flipped whenever the market offered a small profit. Decades later, Buffett highlighted that Berkshire had gone more than 20 years without buying or selling a share of either Coca-Cola or American Express. The companies had continued increasing earnings and dividends while Berkshire's inaction was rewarded. Inaction is an unusual competitive advantage because it does not look like work. In most professions, activity is visible evidence of effort. A surgeon operates, a builder constructs, a driver moves. In investing, the most intelligent action may be to read, think, and then do nothing. This creates a problem for the financial industry. Brokers, commentators, trading platforms, and managers often earn more when customers act. Every new prediction creates attention. Every transaction can create fees, spreads, taxes, or engagement. A patient investor may be a good owner, but a poor customer for businesses built around constant activity. Buffett compared investing to owning a farm. If farmers frantically bought and sold fields among themselves every day, the crops would not grow faster. The activity would mainly increase transaction costs. The same principle applies to stocks. Trading does not improve the factories, software, stores, or customer relationships inside the company. Sometimes selling is necessary. A business can lose its advantage, management can behave badly, the original analysis can be wrong, or another opportunity can be clearly superior, but activity should serve the analysis. The analysis should not be invented to justify the activity. So why are people repeatedly attracted to quick money? Because quick money combines several powerful psychological forces. The first is social proof. When many people appear to be earning profits from the same idea, the idea feels safer. We assume the crowd knows something we do not. This instinct helped humans survive in groups, but markets can turn it against us. A rising price attracts attention, the attention attracts buyers, and the new buyers push the price higher. The movement appears to confirm the story that caused it. The second force is fear of missing out. A normal profit rarely feels painful when no one is watching, but when a friend, colleague, or stranger online claims to have doubled their money, patience can feel like failure. We stop asking whether the opportunity makes sense and begin asking whether we can tolerate being left behind. The third force is availability. Dramatic success stories are memorable. We hear about the person who became wealthy from one concentrated bet. We rarely hear from the thousands of people who made similar bets and quietly lost. The winners are visible because winning gave them a story. The losers disappear from the sample. This creates survivorship bias. If you study only survivors, dangerous strategies can look brilliant. The fourth force is action bias. When uncertainty rises, doing something provides emotional relief. Buying, selling, checking prices, and changing plans create a feeling of control. Waiting feels passive, even when waiting is the rational decision. Buffett built habits that protected him from these forces. He read for hours. He stayed in Omaha, away from much of Wall Street's social pressure. He worked with a small team. He refused to make forecasts, simply because the public wanted them. He kept what he called a circle of competence. A circle of competence is the area in which you can evaluate a business with reasonable confidence. The size of the circle matters less than knowing its boundaries. You do not need to understand every industry. You need to know when you do not understand one. This is intellectual humility. In a world that rewards confident opinions, saying, "I don't know," can look weak. In investing, it can protect capital. Buffett avoided many technology businesses for years because he did not feel able to predict their long-term economics. This did not mean technology was unimportant or that every technology company was a bad investment. It meant that he could not estimate the future with enough confidence to act. Missing an opportunity is emotionally difficult, but it is not the same as losing money. There are thousands of possible investments. Buffett did not need all of them. He needed a small number that he could understand, purchased at prices that allowed a margin of safety. The margin of safety is another idea Buffett learned from Graham. Imagine building a bridge that is expected to carry 10,000 kilograms. An engineer would not design it to collapse at 10,001. The bridge would be built to carry much more than the expected load because estimates can be wrong and conditions can change. An investment needs similar protection. If you estimate that a business is worth $100 per share, paying exactly 100 leaves no room for error. If your assumptions are slightly too optimistic, your return may disappear. Paying much less creates a cushion. The margin of safety is not a guarantee. It is recognition that the future is uncertain and your calculation is imperfect. Quick money stories usually do the opposite. They require several optimistic assumptions to come true at once. Growth must remain extraordinary. Competition must remain weak. Financing must remain available. Buyers must continue paying higher prices. Buffett preferred investments that did not require a perfect future. He also distinguished between risk and volatility. Volatility describes how much a price moves. Risk, in Buffett's practical sense, is the possibility of permanent loss or an inadequate result. A stable price can hide a dangerous asset. A volatile price can surround a strong business. If an excellent company falls 30% because frightened investors are selling everything, the quotation has become more volatile, but a lower purchase price may actually reduce the long-term buyer's risk. This is why Buffett could act during crises. In 2008, fear spread through the global financial system. Institutions failed, credit markets froze, and investors rushed toward cash. Berkshire also suffered declines, and Buffett admitted making mistakes. But because the company had maintained liquidity and avoided depending on short-term funding, it was able to make investments on terms that were rarely available in normal markets. This can look like bold timing. It was really the result of years of preparation. Opportunities become valuable only when you have the resources and emotional stability to use them. Cash often produces a lower immediate return than other assets. During a rising market, holding it can make an investor look cautious and outdated. But cash also creates optionality, the ability to act later without asking permission. Optionality has value even when it is not being used. A fire extinguisher produces no income while hanging on the wall. That does not make it useless. Its value becomes visible in the rare moment when everything else is on fire. Buffett did not predict the exact date of every crisis. He built a structure that did not require such prediction. This is a crucial distinction. Forecasting tries to know what will happen. Preparation tries to remain strong across several possible futures. Buffett often acknowledged that he could not predict next year's market. Instead, he focused on things that could be evaluated more reliably: the financial strength of Berkshire, the economics of its operating companies, the quality of managers, and the price paid for new assets. The lesson is not that macroeconomics never matters. Interest rates, inflation, regulation, and recessions affect businesses. The lesson is that broad predictions are often too uncertain to support precise decisions. Buffett preferred to place his attention where it could produce an advantage. That attention was rarely focused on getting rich quickly. It was focused on avoiding stupidity, understanding a few businesses, paying reasonable prices, and giving good decisions time to work. There is an important difference between slow and passive. Buffett's results did not come from buying anything and waiting forever. Patience cannot rescue a business with collapsing economics. Time is the friend of a wonderful company, but it can be the enemy of a weak one. Long-term investing still requires work. You must understand how the company earns money, what customers value, why competitors cannot easily take those customers, how much debt the company carries, whether management allocates capital responsibly, and whether the purchase price allows a satisfactory return. Holding for a long time is not a substitute for analysis. It is what allows good analysis to become valuable. Think like an owner. Separate price from value. Stay inside what you understand. Demand room for error. Avoid leverage that can force bad decisions. Keep costs reasonable. Do not confuse activity with progress, and allow compounding enough time to become visible. For most people, Buffett's own public advice was even simpler. He argued that a typical non-professional investor did not need to identify the next Coca-Cola. A low-cost index fund could provide ownership in a broad collection of businesses. The key would be consistent participation, low costs, diversification, and the ability not to sell in panic when the news became frightening. This may sound less exciting than finding a secret stock. That is exactly why it is powerful. The financial world is very good at selling complexity. Complexity makes a product appear sophisticated and makes the customer feel that ordinary rules no longer apply. But a strategy does not become better because it is difficult to explain. Buffett admired simple systems whose logic remained valid when emotions became intense. Simplicity is not the same as ease. Buy productive assets and hold them is simple. Watching those assets fall while headlines predict disaster is not easy. Do not chase what you do not understand is simple. Watching other people become temporarily richer is not easy. Wait for an attractive opportunity is simple. Sitting with cash while the world celebrates is not easy. The challenge is behavioral. Buffett's advantage was not only intelligence, it was temperament, the ability to remain relatively rational when markets encouraged greed or fear. Temperament can be strengthened by design. You can reduce how often you check prices. You can create rules before a crisis arrives. You can avoid borrowing that places a deadline on your decisions. You can write down why you bought an asset and what evidence would prove the thesis wrong. You can compare yourself with your own long-term plan instead of the most successful stranger on the internet. You can also ask a powerful question before any investment. If the market closed tomorrow and I could not see a price for 5 years, would I still want to own this? The question forces your attention away from resale and toward production. Would the company still have customers? Would its advantages remain? Would it generate cash? Would management use that cash intelligently? If the investment only makes sense when another buyer appears quickly, you are relying on the market's mood. Buffett preferred to rely on the business. This does not mean quick profits are always bad. Sometimes a sensible investment rises rapidly. Buffett would not reject a gain simply because it arrived early. The problem is making speed the reason for the decision. A fast result can be a welcome accident. It should not replace a sound process. This is the deeper meaning of Buffett's refusal to chase quick money. He understood that wealth created too quickly can train the mind to expect conditions that cannot last. It encourages larger bets, weaker standards, and greater confidence at exactly the moment caution is needed. Slow wealth teaches different habits. It rewards saving, reinvestment, resilience, and the acceptance that meaningful results often look unimpressive at the beginning. For many years, Buffett's advantage was not visible as one dramatic event. It accumulated through thousands of decisions: businesses not purchased, trends not followed, fees not paid, shares not sold, earnings reinvested, and crises survived. There is also a personal lesson in Buffett's approach. People often chase quick money because they are not really chasing money. They are chasing proof. Proof that they are intelligent. Proof that they are ahead. Proof that they chose correctly. Markets offer a daily scoreboard, and a scoreboard can turn every decision into a judgment of personal worth. Buffett tried to separate the quality of a decision from the market's immediate reaction. If the analysis remained sound and the business continued performing, a lower price could be an opportunity rather than an insult. That emotional separation is difficult, but it is essential. A quotation is not a verdict. It is an offer. At the age of 11, Buffett watched a price fall, felt relief when it recovered, and sold for a small gain. Decades later, his philosophy had become almost the opposite. He wanted to buy businesses he would be comfortable owning, even if no daily quotation existed. The child watched the price. The mature investor watched the business. That transformation explains far more than any list of successful stock picks. It explains why Buffett could hold through uncertainty, why he could ignore fashionable markets, why Berkshire could wait with cash, and why he repeatedly warned people about promises of easy wealth. He knew that the market offers endless ways to feel rich temporarily. His goal was to become wealthier through ownership of things that continued producing value. And that is the final distinction. Quick money asks, how soon can I sell? Long-term investing asks, what deserves to be owned? Quick money looks for excitement. Compounding looks for durability. Quick money needs the crowd to remain enthusiastic. Productive ownership can survive the crowd becoming bored. Buffett did not become successful because he moved faster than everyone else. He became successful because he understood when speed was irrelevant. He gave good businesses time. He gave retained earnings time. He gave trust time. He gave compounding time. And while the world repeatedly searched for a shortcut, he allowed the long road to become his greatest advantage. The lesson is not that everyone should copy Warren Buffett's investments. It is not that every stock should be held forever, or that patience alone guarantees success. The lesson is more useful than that. Before you chase an opportunity, ask what is actually creating the return. Is a real business becoming more productive? Are customers receiving something valuable? Are profits being reinvested intelligently? Is the price reasonable compared with what the asset can produce? Or are you simply hoping that someone more excited will arrive after you? One path depends on economics. The other depends on emotion, and emotion can reverse without warning. Warren Buffett never needed money to arrive quickly because he understood something most people only appreciate after many years. When capital is protected, intelligently invested, and allowed to compound, time is not the cost of the strategy. Time is the engine. That is why he never chased quick money. He was waiting for something far more powerful. Money that could keep working long after the excitement was gone.